global economic outlook is taking a hit as the war in West Asia begins to ripple through markets. The International Monetary Fund has cut its global growth forecast for the year 2026, warning the world economy could be thrown off course. Now, in the latest World Economic Outlook, the IMF now expects growth at 3.1%, down from its earlier estimate of 3.3%. The downgrade comes after the conflict between the US and Iran disrupted commodity markets and pushed prices higher. Listen in.
Our report presents three scenarios. Our reference forecast assumes a short-lived conflict and a moderate 19% rise in energy prices in 2026. Still, some damage will not be avoided. Global growth falls to 3.1% this year, a downgrade from January forecast, and headline inflation rises to 4.4%. Our adverse scenario assumes further disruption, leading to higher energy prices and inflation expectations and tighter financial conditions throughout the year. Growth falls to 2.5% this year, and inflation rises to 5.4%. Our severe scenario assumes that energy supply disruptions extend into next year, with greater macro instability. Global growth falls to 2% this year and next, while inflation exceeds 6%.
Global oil prices are experiencing volatility of the kind they've not seen in recent times. In the midst of it all, however, India's robust macroeconomic and financial sector fundamentals are likely to cushion the impact of even a sustained global oil price shock. Now, economic growth could slow down, however, by up to 80 basis points if crude averages at $130 per barrel through the year 2026, and this is according to data from S&P Global Research. Now, if the oil stress continues, corporate earnings in India before interest, tax, depreciation and amortization, popularly known as EBITDA or operating margins, could decline by 15 to 25% in this financial year, that's FY27. The banking sector asset quality may weaken, pushing bad loans to around 3.5%. Indian banks seem to be well positioned to absorb the looming oil shock, supported by strong capital buffers and low non-performing assets, though credit costs may rise modestly and profitability could also come under pressure this financial year. Now, S&P Global Ratings assumes Brent crude at $130 per barrel in 2026 and $100 a barrel in the year 2027 under the global oil stress case. Now, it does not expect any immediate impact on India's sovereign ratings, though fiscal consolidation efforts could face temporary setbacks. However, global oil prices, which are higher now, could widen the current account deficit, with estimates suggesting that a $10 per barrel increase in prices of oil may expand the gap by about 0.4 percentage points for India's GDP. Now, for a projected GDP of 6.8% for this financial year, the slump would still keep India's growth rate above the 6% mark. And remember, we are talking about a bad case scenario with Brent at $130 per barrel for this year. Now, the rupee could also face depreciation pressures amid risk of sentiment and a rising import bill. Now, S&P Global also warned that if the government stepped in with subsidies, an energy shock would in turn get transmitted through higher input costs, squeezed corporate margins, rising consumer prices, and increased fiscal. Now, growth could also be hit by potential supply disruptions affecting fuel and petrochemicals. Now, despite these risks, India's economy entered 2026 with strong growth momentum, resilient domestic demand, and low inflation, which should help absorb near-term shocks. Overall, S&P Global Ratings said India can weather a few months of elevated oil prices and supply disruptions, though a prolonged shock would pose broader risks to growth, fiscal stability, and external balances. It said India is equipped to handle some strain. Robust corporate balance sheets provide cushion against higher energy prices. Banks, meanwhile, have strong capital and profitability. And in further likely bad news for India's economy, IMD has predicted below normal southwest monsoon in the June to September period amid growing risk of El Niño, which is linked to depressed summer rainfall in India. IMD forecast gives a 31% probability of below normal rains and a 35% chance of deficient rainfall, a clear indication of significantly less than normal monsoon this year. The forecast that is likely to firm up by the month of May, in fact by end May, could mean bad news for India's farm sector, especially in the central and western parts of the country that depend on the southwest monsoon for most farming operations. Irrigation, drinking water availability, reservoir capacity and hydropower potential all get impacted, and the effect could spiral into more challenging times with elevated prices of fertilizers and commercial diesel anyway adding to input cost woes given the conflict in West Asia. Now, depressed rainfall not only impacts the summer sown kharif crop but also the winter rabi crop that is dependent on high moisture content in the soil.